Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Today's topic is how does inflation affect the housing market? The inflation numbers were released today. CPI increased 8.5%. 6.5% does not count food and energy, which can tend to be they affect each other. Energy costs tend to make food costs more, so they take those out to give you sort of a core or closer to like actual inflation rate.
So the items that they're looking at with these numbers are durable goods, right?
Yeah, and services and things like that they can measure. Air travel, how much your car is, used car, new cars, whole things like that.
Right.
So,
a washing machine, things that are more than consumables.
Right. So we're going to talk specifically about the housing market now. Because of this, the Federal Reserve has raised the discount rate, the federal funds rate, right? And the federal funds rate, of course, is an overnight rate that Federal Reserve banks charge each other. If you look at this chart and look back, you can see at times we had very, very low inflation, and so the economy was they held interest. The federal funds rate was like 0.25%. It was the banks could basically. That's why interest rates were so low for home. So what's happening now though is the Fed is gone and they're raising rates, and what that's affecting is mortgage lending. Okay. Because remember, the prices of real estate are based on supply and demand in the real estate market, almost exclusively. Now you say, well, interest rates affect the housing market because they affect demand, but they don't affect the housing market outside of demand. They affect demand because they change the number of potential buyers, or they increase or decrease the number of potential buyers in the market, right? So let's start with that. Current mortgage rates are about 5%.
Right.
Okay. Now, if you're borrowing money to buy a house at 5%, that's more than people paid in the last few years.
Well, that's more than people paid 4 months ago.
Right. 4 months ago. Okay.
4 months ago, it was about half that.
But what if you borrow money at 5%? That's still better 8.5% inflation.
Absolutely.
So, do you believe that? Okay, let's talk about the inflation interest rate versus home prices. You want to buy a house, and you just decide to do it, and you jump out there, and you find out it's going to be 5%, right? Historically, 5% is very low.
It is. I mean, look, up until really the last 4 or 5 years, 5% would have been fantastic. Lots of people refinanced happily to 8%, to 7%, because there are those of us that maybe had mortgages that were 11, 12, 13% back in the 90s. And so when interest rates went down to 9%, we refinanced. When they went down to 7%, we refinanced again. And we just kept doing that. So the interest rates that were 2% or give or take even 3% were just unbelievable. I mean, it was almost like you got to borrow the money for free. 5% is not a high interest rate, not when you consider how much historically it has cost to borrow money, particularly for a mortgage. So 5% is still a great interest rate, and people like me who had mortgages that were at double-digit interest rates, we don't have a lot of sympathy for you guys.
Okay, here's another problem with inflation in the housing market. Inflation makes things cost more, which means it costs more to build a new home.
Right.
So if it costs the builder more, he has one of two choices. He either has to charge more for the home, which he may not be able to do, or not build. Like decide not to build. Like say, hey, we're gonna build less because we can't build as much, right?
Well, the other thing that they'll do is they will build differently, and what I mean by that is they will put more homes on their in their home subdivision, so the homes will be on smaller lots, because they'll charge the same as they were charging for a home on a bigger lot, but they're trying to manage their costs.
Something else to think about. This is a emotional reaction. People say, oh my gosh, interest rates are going up. I'm going to go buy a house and lock that loan at 5% because I heard they're going to be 6 by the end of the year, and I don't want to wait and pay another percent in interest. So this potentially could rush people out, despite there's being because they're anticipating the future. They're trying to guess what's going to happen. So they rush out there to buy, and then that could effectively increase the demand, which is also potentially pushes up home prices.
Right, and we do know people like that who maybe they were on the fence, and as they're seeing these interest rates rise, they're thinking, okay, this is the time I'm going to go and buy that house that maybe I was going to buy maybe later in the year, or maybe next year, and I'm going to go out and buy that house right now.
Another interesting thing is that the last time we had this much inflation was about 40 years ago, and home prices were going up.
They were.
And interest rates were going up, and interest rates were really high, but it didn't stop. I mean, it didn't stop the housing market from going up. And one of the reasons is because housing is a hedge against inflation. So if you know you're going to have 4 or 5% inflation, you want to go buy a house. And because what's going to happen? You're going to be able to get more in rent every year. The thing's going to appreciate in value, and you're going to lock in a 5% rate. Look, here's the bottom line. If I told you tomorrow we were going to have 5% inflation, everything was going to cost 5% more, and I gave you an unlimited amount of money you could borrow at 5%. You could borrow as much money as you want at 5%. You could go buy houses that would appreciate at 5% a year, and then the rent would all be free. You would just basically get free rent, because you could pay the 5% would cover the depreciation would cover the payment, right? The 5% you're borrowing, and then the rent would all be free. Or you could use the rent to pay off the mortgage, and then the 5% appreciation every year you keep. So you could say, okay, give me $1 billion. I'm gonna go buy $1 billion of single family homes. You go buy them, and you make $50 million a year just in free money, because you're borrowing it cheaper than inflation is pushing the nominal value of everything up. And you bought that loan at a fixed rate.
Right. The issue is that everybody's money that's sitting there in the bank is actually devaluing. It's actually being devaluated every day with the inflation.
Here's another thing how inflation affects the real estate market. So inflation pushes up interest rates. But then remember that people still, Pollyanna, say, "Oh, hey, but you know what? They're going to be less," because this is a truism. On average, when interest rates start rising, they only rise for 18 months, and then they decline. And if you go back and look at every time mortgage interest rates rose, they rose for about 18 months, and usually the Fed then started using monetary policy to keep the economy from crashing and lowering rates and try to get inflation. Once inflation got under control, they would start lowering rates again. And we're already 6 months into this almost of interest rates going up in the mortgage industry. And mortgage interest rates have been going up. So we maybe have a year of this left. So what people will say is, "Oh, who cares what the rate is? Because I'll just get whatever the loan is. I don't care. I'll just refi it. Do a refi in a year when it's 3% again, or when it goes back down."
So to kind of give you perspective, I see the Fed as this this little granny driving down the road doing this with the steering wheel, and trying to keep the economy on course. Lowering the interest rates, raising the interest rates, all in an effort to kind of keep everything on course.
Yeah, inflation definitely does affect the housing market through two things. It affects the mortgage interest rates because the Fed starts moving the needle. And then it creates a psychological thing where people want to get real estate to hedge against inflation. It literally drives more people. I believe that the spending of the last year has probably pushed Wall Street. I think people in Wall Street said, "We're going to have inflation. I know we're not seeing it now, but we're going to have it. Let's take our money and push it over there into real estate assets. Let's forget the stock market, because if the economy tanks, and that's fine, they're going to get killed in the stock market, because companies are going to have their earnings are going to be terrible. The multiples on stocks are going to start rising again, right? Then they become a less of attractive investment asset. But then what's great, real estate's just inflating.
Right. So and we've seen that certainly over the last couple of years. We have seen these institutional investors that we've talked about before that are investing billions of dollars in real estate across the country, in residential real estate, because they are using that to balance their portfolio and guard against inflation.
Yeah, I think the biggest factor, I think that the amount of mortgage rates going up is not as big of a factor for demand as inflation is. Because we've seen before, we did a video on it, inflation, when we have high inflation, real estate goes up.
Right.
And people are keeping their money, their dollars,
Right.
that are not invested in anything from being deflated. So potentially what happens is you cut out some people who maybe can't afford to buy, they don't meet the ratios, but then you throw in a whole bunch of extra people who are like, hey, we've got cash, we want to buy, we want to get, we don't want our money to be inflated at 5 or 6. Now, if you have $1 million in cash in the bank and you have 5% inflation, you're losing $50,000 of buying power every year.
Right. Something that I haven't seen anybody else talk about, and something I'm going to talk about, is the baby boomers. Now, the baby boomers are either have retired or are due to retire soon, and they are definitely changing the allocation of their assets. So they're maybe pulling some money from other investments and putting them into real estate because they realize that real estate is going to help safeguard them against inflation, because they are at the end of their earning life and they're trying to safeguard their nest egg against inflation. And that, I think, is playing into this as well. So it's not just the hedge funds and these institutional buyers that are in there trying to use real estate to guard against inflation. I think you're looking at a lot of people who are either close to retirement or have just retired. They're in that kind of 10, 15-year span, somewhere between maybe 55 and 70, and they're taking money from other investments and putting that into real estate. I've seen that personally from people around us that have done that. And it's really interesting because I don't know that they've done it consciously, but they're all doing it, us included. It's kind of interesting how we all get to that point in our lives and engage in similar behaviors without really realizing that we're all doing the same thing.
Yeah, that's certainly the case. What we need to have happen are two things. First of all, we have a massive shortage of homes in the U.S. Massive shortage. We did a video on that last month. We need to fix that, and the only way to fix that is we need to make it easier for home builders to build new homes. We need to make it cheaper for them. So we need to have cheaper cost of goods. We need to have lower inflation. So the Fed needs to fix this, okay? Because this is not going to. This is making the housing market worse. This is not. High inflation is going to make it worse for everybody.
Well, and high inflation is going to make it worse for retirees. It's going to make it so it's going to hurt everybody. It hurts, and inflation is one of these pernicious taxes, really, that hurts everybody across the board, and to a large extent, it hurts the people on both ends of the spectrum the most. So it hurts the people at the end of their lives the most because they're on a fixed income and they have no possibility of increasing their income, and it hurts people that are just starting out in life because they're generally not making a lot of money, and that it makes it very difficult for them to live their lives.
So the other thing we need to have happen, in addition to it, builders building new homes, is the stock market has to get to where it becomes a reasonable investment again. And the reason why is because people right now are looking at, well, why would I, when they see that Shopify or something is down like 78% in value from what it was, a year ago or 6 months ago. And they're like, look at these tech stocks that have tanked. Maybe that's not a great, the multiples don't make sense. These companies aren't making money. And when the economy gets better and the stock market becomes a better relative investment, you'll see people maybe make different decisions in the future. And that doesn't mean they'll sell their house and buy stocks, but that money they've accumulated, they may say, let's put it in the stock market instead of putting it in the housing market. Another thing that people forget is that when you buy a house to live in versus renting and you sell it, you get depending on if you're married or single, anywhere from $250,000 to $500,000 tax-free gain on a primary residence. Okay, there's rules on that. We're not accountants, but you can go look at. You can talk to your accountant, read them on Google. You won't get that when you buy stocks. You don't get that. The IRS doesn't let you keep the first $500,000. and this is your thing, but we've always had it. We've had that for decades, and we have had that for decades, and it's always been a great thing. And what's interesting is the Wall Street companies that are buying these homes for rentals, they don't get that. They don't get that benefit because they're not living in the houses.
No, so to be clear, that benefit is only for your primary residence.
Primary, right? Not for rental house.
So it's not for a rental house. If you own an apartment building or if you own a bunch of rental houses, that doesn't apply to you. It's only for your primary residence, not for your summer house, not for your, whatever your second home is, not for any of that. It's just for your primary residence.
But let's say you sell your primary residence, and then you the lake house that you've been renting out, you move into it, and you move in, you live into it for a certain amount of time, and it becomes your primary residence for tax purposes, and then you sell it.
Right. So, talk to your accountant as to whether or not you can deduct that. Depends on what you did with the first house and all that sort of thing. So we're not going to get into that.
Yeah, but the thing is that there's these, they've created tax law in a way to pump real estate, and because the government obviously has a vested interest in homeowners, and I think we all do to some extent, and we have a very high home ownership rate, but we do have this highest demand ever. We do have the lowest amount of inventory ever, and we just need inflation actually to go away to help the housing market, because people are going to flock to it. If this ends up being a long-term thing like it was when I was a kid in the 70s, early 80s, no, it's going to be, people are going to just, no one's going to sell their real estate. Like, that's the problem. Like, the only people right now selling real estate are doing it for one of two reasons. They have to sell it because of death in the family, or they're moving and they just don't want to be a landlord, or they have some reason they have to sell it. Or they're trying to time the market. They're playing the game of, we're going to move in a year because when the kids graduate, we're going to go and live in blah, blah, blah. Or we're going to move back to our hometown, or we're going to move back to the parents, or we're going to do all this stuff. But we'll sell it now because we want to. We're just afraid if the market. We saw this video this guy did where said the market's going to crash. It was 2 years ago, but we think it's going to happen tomorrow, right? So they're selling it, which is great. If you think the market's going to crash, please sell your house. Give us a call. We'll help you through that. And anywhere in the country, we can help you with a startup called Referral Cloud that we know a little bit about. That we can help you find that agent, sell that house anywhere. So that's the bottom line is we just want to talk about how inflation does affect real estate, and it affects it in two ways, indirectly. Both are indirect, but they actually work against each other, right? Because rising mortgage rates hurts it a little, but then inflation helps it a little because people don't want to sell because they're getting more in rent. It's appreciating. Why would they want to dump that and put it in the stock market that took a dump today? Right? It's not done very well. I think it's down 4 or 5% for the year already.
I try not to look.
We don't look. I stopped looking. So anyway, if you like this video, please share it, comment on it, tell all your friends about it. Watch all the other videos on almost 900. Almost 900. We're gonna have a big party when we do our 1,000th video. On the blog.
There you go.
So
subscribe, hit the notification bell, leave us your comments, tell us what you think. How are you dealing with inflation? What are you doing to guard against it? Because let's face it, if you've got $10, you basically are losing 80 cents. So think about that for a minute. Tell us what you think. Tell us what you're doing to guard against inflation. Hit the notification bell, subscribe, and we will see you on the next video. Bye.
Bye.